Important note, this video is not financial advice. Always do your own research before making any investment decision. Past performance does not guarantee future results. Here's your market briefing from Rumour with AI. The structural decay in global markets is no longer a whisper, it is a roar. We are witnessing a fundamental realignment of asset classes, where traditional safe havens are failing and legacy giants are crumbling under the weight of their own obsolescence. In the crypto sector, the narrative has shifted from speculative mania to corporate survival tactics. SOLAI Limited has executed a drastic 700-for-1 share consolidation. This move follows a suspension by the NYSE, signaling severe liquidity concerns. The company has simultaneously raised its authorized shares to 100 billion, a clear attempt to preserve listing status while navigating the turbulent waters of Solana-linked Treasury strategies. This is not growth, it is triage. Meanwhile, the fixed income market is undergoing a silent crisis. A major U.S. Treasury ETF has plunged to its lowest level in over 2 decades. This is not a temporary dip. It signals deep structural shifts in how capital views government debt. As the Federal Reserve holds rates steady, the market is pricing in a future where the demand for U.S. sovereign debt is evaporating. The era of the bond bull market may be over. On the macro front, volatility is converging across continents. In the UK, unemployment data is shaping Bank of England policy expectations. In Germany, the ZEW index reveals deepening pessimism among institutional investors. But the most critical data point arrives with U.S. housing starts. These figures are not just numbers, they are the canary in the coal mine for global growth. If housing stalls, consumption follows. If consumption falls, earnings collapse. Perhaps the most striking divergence is in the consumer discretionary sector. Nike, NKE, has hit a 12-year low, falling nearly 80% from its 2021 highs. This decline outpaces even Bitcoin's recent corrections. Nike's struggle is not cyclical, it is structural. The brand is losing its cultural relevance, and investors are pricing in a permanent loss of market share. This is a warning shot for all legacy retail brands. Underpinning all this is a measurement crisis. U.S. GDP growth sits at 1.5%, with unemployment at 4.1%. These metrics mask a profound erosion of real economic vitality. Productivity is stagnating. The traditional indicators are failing to capture the decay beneath the surface. We are growing on paper, but shrinking in reality. Looking ahead to today's release, the absence of major high-impact economic calendar events in the next 36 hours is itself a signal. The market is waiting for the next shock. With no data to anchor sentiment, volatility will be driven by narrative and technical levels. Traders must remain agile. The usual guides are broken. The convergence of falling treasuries, struggling retailers, and questionable GDP metrics suggests a market in transition. The old rules no longer apply. Capital is fleeing quality for liquidity. It is a dangerous time for the complacent. That's your market briefing. Follow Rumour with AI for daily market intelligence.